Telis, a lot of people are really worried about this big, beautiful bill out there and how it's going to increase U.S. government deficits.
Yeah, people are talking numbers that rhyme with trillion, and that might trigger you-know-who, the bond vigilantes who really freak out when the U.S. government has to issue a lot more debt.
So our guest today is going to dive into how this impacts the most important financial market on the entire planet, U.S. Treasuries. Hi, everyone. I'm Gunjan Banerji.
And I'm Telis Demos.
And this is WSJ's Take on the Week, a weekly show about money and investing. Telis, I think there's one stock out there that tells you almost everything you need to know about markets right now.
What's that? It's NVIDIA, right?
It's not NVIDIA. It's not NVIDIA, and it's not a big tech stock. I think it's Robinhood, the brokerage stock. Robinhood stock has roughly doubled this year. And I really think of this as a bull market stock, the type of stock that does really well when stocks are rising, people want to make YOLO bets, when people are feeling good about markets. And I was pretty shocked to see that it's roughly doubled this year, especially after all those tariff fears, all those recession fears that dominated just weeks ago.
Well, I guess volatility is good for the trading business. And it's been such a journey for Robinhood, right? I mean, we had Vlad Tenev on the show, the CEO of Robinhood previously. And even back then, we were already talking about how from the dark days of the meme stock mania and the sort of the challenges that raised for Robinhood's business to, its sort of renaissance, with the Trump trade and everything, everybody being bullish about things. And now it seems like, it really solidifies, I think, that one of the major investment themes lately has been investment, investing in investment and how it's changing. So it's weird to think of investing itself being an investment, but it has been a very good one of late.
Right. And like Robinhood said just this month that stock trading is up on the platform, crypto trading is up on the platform, options trading is up. So all these really risky things have kind of stayed in vogue, and people are trading them on Robinhood.
Yeah, people have not been scared away from that. And Robinhood now has found itself in the middle of sort of politics, too, when,
the Trump accounts.
The Trump accounts, right? So this is potentially part of the OBBB, the one big, beautiful budget bill. I don't know. I'm not counting my Bs. I may have too many or too few in there. But you know what I'm talking about, Trump's budget and the Republican budget.
Sure.
Basically, it's a brokerage account that, you would give to kids. Every kid would get some sort of brokerage account. And Robinhood has said that it could provide the technology for these accounts. And they even, I think, sent around screenshots of what that would look like. And, Vlad Tenev, again, the Robinhood CEO, was at the White House to talk about this with some other executives.
Yeah, I'm curious to see how that shakes out in this bill. One of the most surprising things to me, and I think a lot of investors out there, is just how this appetite for risk-taking hasn't really gone away despite higher interest rates. And now I think after this recent inflation report, which showed that inflation is cooling, people are wondering, hey, are we going to get lower interest rates soon?
Yeah, I definitely think bullish people are going to feel vindicated by the fact that it seems like there's a case now to be made a lot stronger that maybe the Fed should, in fact, cut rates this year. A lot of people have been saying for a while that they don't think they will, right? If you read a lot of Wall Street economists, a number of them have a case that the Fed can't really cut rates in 2025.
Right, that will be in higher for longer, for much longer.
Right, and that the uncertainty about tariffs and their impact on prices will just sort of stay the Fed's hand. Jerome Powell famously said, something like wait and see, many, many times
right.
during the last Fed press conference. But have we waited long enough and seen enough? I think that would be really interesting to hear from the Fed in this upcoming meeting.
And what we saw in trading in recent days around these inflation reports was people ramping up bets on 2 or more rate cuts this year.
Our WSJ economics writer, colleague Greg Ip, thinks that maybe there is a case to be made for the Fed to start cutting. But like I said, a lot of economists still think that the Fed probably won't. For example, the team at Bank of America, their BofA Securities, said that despite this last inflation report, they still think that there's a case to be made that the Fed won't cut rates this year. And I think that gets into what you and I have talked a lot about, and I think has really become key for investors because let's face it, a lot of people have money in cash and money market accounts. A lot of people have bought bonds over the last couple of years, and that's the Treasuries market. And what all of this, what the Fed does, what's going on with the U.S. budget discussion, what that means for yields on U.S. Treasury bonds. that's why I think we have a really important conversation coming up. We called in the U.S. rates strategist at Bank of America's BofA Securities. Her name is Meghan Swiber, and she's going to talk to us about all the things going on in the U.S. Treasury market, which of course is the world's largest bond market. It's how the U.S. government funds itself.
Sure.
It's also how savers here in the United States and around the world kind of keep their money to earn a little bit of yield on it. And it's been a wild ride these last few months, and it doesn't look like the wild ride is going to stop anytime soon. So when we come back, we're going to have that conversation with Meghan.
I'm excited for this one.
So we are here talking with Meghan Swiber. She is the senior U.S. rates strategist at Bank of America's BofA Securities. So the Treasury market.
Yes.
Not something that most of us think about as like a super exciting part of the market most of the time.
Maybe not most of us.
Okay. Well, let's see. So I guess to you, the Treasury market is always exciting.
Always an interesting place. Yes. The Treasury market for sure, maybe is not the top of everyone's minds all the time, but interest rates, U.S. interest rates really are such a barometer and a price setter for everything else. So it's a very fundamental market, which is why when something goes awry, it captures market attention across the board.
And I guess to a lot of us, it feels like the Treasury market is more volatile than usual.
Yes.
Is that actually the case, or is it just because we're paying attention?
So one of my favorite charts, Telis, if you look at intraday volatility in Treasury yields, you kind of standardize this over time. There's two very big blips that stand out in the history over the past couple decades. One is COVID, and one is what we saw in April. So, certainly what we're seeing in U.S. rates volatility is elevated. It's as we've been discussing, it's been a huge focus across clients, across markets. But yes, indeed, we're seeing very elevated rates volatility in the U.S. market. This is coupled with concerns around liquidity and market functioning in treasuries. Usually when we see these big blips, it means that something else is going on. It means that investors are changing risk-taking, which can usually exacerbate moves that we see in rates. Things are settling down a bit in rates, but it's still definitely a focal point for folks as everyone's still trying to understand what is going on in the macro environment, and rates are the place where we see that priced most clearly.
And we are so focused on the Treasury market, I guess, for a couple of reasons, right? One of which is it's basically the world's largest bond market. Mm-hmm. Is that correct?
Correct.
Okay. And it also is obviously where the U.S. government goes to fund itself, right? Like the Treasuries market, as the name implies, are issued by the U.S. Treasury. And that's when the government, which I don't know if anyone knows this, on occasion the government spends more than it takes in. And so it has to go out and borrow. And it does this by selling treasuries to the market, right?
Yes.
Okay.
And so the other reason why they're so important is because they're thought of as the global risk-free asset class. So when things are selling off and hitting the fan, usually what we see is investors rush to treasuries to be that important diversification product. When we think about some of the volatility that we saw in April, what stands out to us is that you had certain parts of the treasury curve not behaving in that normal way that we see. And that's driving a lot of questions for multi-asset investors who are scratching their heads thinking, okay, well, if it's not treasuries, what else should I be buying to better diversify my portfolios?
What makes treasuries risk-free? Can you kind of define what that means for us?
Well, it's generally believed to be the case that the Treasury is going to be paying back those debts, those obligations. I don't really think that that's what's being called into question here. Everyone does have still thinking of the U.S. as a credible creditor.
Though it was downgraded,
though it has been downgraded.
The credit rating of the sovereign credit rating of the United States.
Yes,
okay.
And it's because when we look at, while investors, I think, in the near term have conviction that Treasury is going to be paying back its obligations, we look at what the trajectory looks like over the next decade, and things get a little hairy. What we're seeing right now is the demand base buyers in across the Treasury curve behave a little bit differently than we've seen previously. And we're seeing that happen alongside still very notable issuance that has to be coming from Treasury. So when we look at the deficit trajectory over the next 10 years, we have the latest expectations from CBO on this. One thing that stands out to us is that even if you look at interest rate expenditures, in about 10 years' time, interest rate expenses alone are expected to be about the size of the deficit in total last year. So this is becoming an increasingly large chunk of what Treasury has to go out and finance itself to pay for. And it means that legislation and politicians, there's a component of the deficit every year that's becoming less and less tangible in terms of what policymakers can change.
All right. So you brought up a few things that I think help us understand why the Treasury market is in focus.
Right.
You mentioned the deficit,
mm-hmm.
right? And that's a topic of conversation right now, I guess for a few reasons, one of which is, of course, that the Republicans who control both the presidency, the House, and the Senate are right now coming up with a budget.
Sure.
And the numbers, you mentioned CBO, the Congressional Budget Office, the estimates are that it is going to continue to, the U.S. government will continue to run a big deficit. There are going to be tax cuts, offset with some spending cuts, but not enough. Now, I feel like I've been having this conversation for my entire adult life with people hearing about this concern. Why now? Why is this particular budget episode rattling the U.S. government bond market so much?
So it's coming at a time when investors are thinking about this shift in correlations that we're seeing in treasuries. And it's also coming at a point in time when we're seeing foreign private investors who make up a very big chunk of treasury holdings. They hold about a third of the treasury market right now, are rethinking how they want to be allocating to treasuries. Deficits have been high for some time now. They were certainly higher during the pandemic. But what we're seeing is that the buyer base in treasuries is changing, and they're rethinking this natural risk-off asset class premium that treasuries have been trading with. And this is coming at a time when a lot of investors are stepping back and saying, well, deficits appear to be only going higher and will continue to have a $2 trillion or so handle over the next several years. So it's this contemplation of more issuance to come from Treasury, but it's also coming alongside the way investors are thinking about how much they want to be allocating to Treasuries. As we saw a lot of this volatility take place in the Treasury market in April, one thing that we saw alongside that was a lot of volatility in the U.S. dollar, right? We saw a very sharp depreciation of the U.S. dollar
plays a role here too.
that really still hasn't recovered fully from that episode. And while we've seen risk assets broadly recover from what we saw in April, we're still seeing the dollar trade a lot weaker. So investors' perception of the dollar overall is actually a very important component of this.
So for a trader, what it ultimately relates to is worries about the dollar, which at the heart of that are what? Are really worries about the long-term health of the U.S. economy, right? That we won't be able to grow enough to pay for this additional borrowing.
Yes.
Is that what you would say is ultimately, when you kind of dig down, is at the base of this? Is worries about the U.S. economy?
Yes, I think that's at the base of it. But it's also, Telis, when we think about portfolio construction, right? A lot of these relationships and a lot of the reason why people allocate a certain risk to dollar U.S. Treasury securities is because of the negative correlations that we see between Treasury returns and other asset classes.
Meaning that Treasuries perform inverse, right? When your stocks are doing poorly, your bonds are doing well.
Right. And the dollar usually
we're all used to that. I mean, even as individuals in our retirements,
in our own
right?
portfolios.
We all have,
allocate,
I guess the classic 60-40 allocation, right?
And what everyone's trying to understand now is whether or not the shift in correlations that we've seen between the dollar, treasuries, high yield, equities, is that fundamentally changed, or does that come back to what we saw pre-April? When we usually see the dollar appreciate in bad states of the world, when we usually see treasuries rally in when we're worried about macroeconomic downside risks, right? So the question is whether or not we stay in this current environment, which really limits capacity for many, many asset managers, investor bases to take down treasury debt.
The Treasury sells different products, right? Yes. They sell bills that mature in a couple of months.
Sure.
They sell bonds that mature in 30 years. And so the short end of the curve is kind of something closer to what we think of as the cash in our in our pockets, right? Like it's not giving money to the Treasury for 30 years. It's a short obligation. And so the cash that we all have in our portfolios, like, is that kind of what everyone wants to own right now, is basically just be in cash?
Yes, but also what we see is that if things really do go badly for the U.S. economy and we're in a recession, there's greater conviction that the Fed is going to cut rates over the next 5 years, and that will lower and compress these shorter tenor rates versus the long end of the curve.
You don't want cash in that scenario.
Right. Exactly. So the fact is that the market believes that there's more capacity for yields at the front end of the curve to move lower than the long end of the curve if the Fed has to cut rates, because we're seeing more of that sensitivity between the front end of the curve and Fed path than the long end of the curve and the near term expectations for what the Fed will do.
But I don't think you guys at Bank of America think that the Fed's going to be cutting that aggressively.
That's right. That's right. But the way investors are set up in their portfolios, right, when they're trying to think about risk allocations versus where on the curve they want to be buying, the part of the curve that will still demonstrate some of this diversification benefit, risk asset sell-off, is going to be the front end of the Treasury curve, where you have greater capacity for rates to rally in that situation.
So is there still a hope that the economy can basically continue to grow strongly enough to just sort of erase a lot of this problem, to soothe people's concerns that, the U.S. won't be able to pay its debts in the future without, like, obviously the U.S. can always print more money to pay these things, but, like, if it has to inflate the currency to do so, that's kind of bad for your bonds. Like, is there still a pathway here to normalizing if the economic data that we keep seeing comes in pretty strong? Will that sort of make everybody feel a little bit better about this stuff?
I think it can to a certain degree. If we continue to see better data come in, the question is, can we see the dollar recover at all from the notable weakness that we see, even on the back of a pretty strong labor market print? But what is a bigger issue here is the fact that even if the economy does muddle through, we avert this recession, growth is relatively strong, we still worry about the demand base for Treasury securities, because usually in these very bad states of the world, when we're worried about the performance of risk, we usually see this huge pickup in demand for Treasury securities. But what we have right now is the fact that the market's pricing and expecting inflation risk. The Fed is expecting upside risks to inflation, and fixed income securities don't usually do well in inflationary states of the world, right? If you got a fixed income stream, you're obviously going to demand more compensation to own that fixed income stream if you're expecting that prices are going higher. So inflation is a big issue here in terms of thinking about the general demand base for the Treasury market overall right now. And it also means that if inflation can prove more persistent, which risks happening if the economy is more well supported, that there's less capacity for the Fed to cut rates, and therefore there's less of this demand for investors to want to buy rates at any part of the curve, because they're worried that there's less concern that the Fed is ultimately going to be lowering rates and us being able to see duration rally in earnest.
Let's just pause to remember that U.S. Treasury yields on those longer-term bonds, 30 years, 10 years, 5 years, are right now basically in the ballpark of the highest they've been since before the 2008 financial crisis, right? Which means they're cheap.
Yes.
Which means they're really cheap. Mm-hmm. Stocks, on the other hand, are very expensive right now. The price-earnings multiple on the stock market is quite high. So as an investor, thinking about my retirement and stuff, should I be buying treasuries at these nice, big, fat yields? Or do I have to worry that things are going to get worse from here, and if I buy them now, I'm basically going to regret not buying them when they were yielding 6 or 7 or 8%? How do you think an investor thinking about their longer term should be behaving right now?
So time horizon's important here.
Okay.
And when we think about buyers in the Treasury market, right, a lot of them have mark-to-market risk, where they're worried about how Treasuries are going to perform over the next 12 months. When we look at this from even a technical perspective in terms of how high yields can get, when you don't have this very firm buyer at the back end of the market, usually we think pensions and insurance companies can be the ones to kind of swoop in and buy more supply if yields get to a certain level. We're really not hearing that from a lot of the pensions and insurance companies that we talk to. They're not buying as much.
Another
and they're
buyer
not as convicted that 30-year yields can only get to 5.2%, right? So the issue is that certainly if you're going to buy and hold that 30-year Treasury security to maturity, it's a great part of a total portfolio construction plan, right?
Okay.
There's certainly a lot of risks and a lot of reasons why we should believe that 30-year yields should be trading below 5% over time, especially if the Fed does have to cut rates more than what the market is pricing. Or if we end up in a recession over the next 30 years. All of these things seem very plausible in 30 years, right? But if you're thinking about what your mark-to-market on holding that 30-year Treasury security is going to be over the next 12 months, right, we don't have a lot of conviction to say that 30-year rates are definitely going to be lower versus higher.
We're going to take a quick break, and when we come back, we've got one more question for Meghan Swiber of BofA Securities. All right, we're back with Meghan Swiber. Meghan, we've got one last question for you. In 30 seconds or less, we've heard some high-profile people, the likes of Jamie Dimon, talking about the Treasury market breaking. Can the Treasury market really break? Is that possible?
So not in an environment where we have a Fed and Treasury that's willing to step into the market and calm major sources of dysfunction. Now, when the Fed looked at what we saw in April was not enough to get them to get stopped back into the market, but what they're going to pay a lot of attention to is funding in yield levels.
All right. So once again, the Fed will ride to the rescue as it has so many times for us in the past.
Quite likely.
All right, Meghan, thanks so much.
Thanks for having me.
Sometimes they will talk just to me.
Okay, yeah, I was going to say
when we want to talk about you.
All right, there we go.
There
we go.
It's like we have we've taken the high school cafeteria and just turned it into a digital reality here.